top-line gain of 8% in Greater China, driven by iPhone sales, switchers, which are consumers buying the iPhone for the first time or switching from another brand, a non-Apple brand. What's really confusing is that in the early days of the iPhone 15 Pro going on sale in particular, there were long shipping delays in China, which suggested that demand was great. Now that the dust has settled and you read some of the sell-side research, supply chain constraints might be an issue here. Ironically, the picture in the United States is much improved, where we've seen a lot of weakness in the global smartphone market. So it's a really contradictory picture to what we've seen so far this year, but it is a concern given that a quarter of revenues come from Greater China.
Ed Laszlo, Caroline Hyde, Noon Eastern, Bloomberg Technology. Look out for that a little bit later. Ed, thank you. If you're just joining us, about 9 minutes into the session, equities lower by 0.6% on the S&P, down a lot more on the Nasdaq, down by about something like 1% on the Nasdaq 100. If you're looking at the bond market, big move higher in yields off the back of better than expected economic data in America. We're up 12 basis points on a 10-year, up 10 on a 30-year, up 8 on a 2-year. Constructive over at HSBC. Max Kettner has this to say: earnings growth expectations for the upcoming Q3 reporting season look manageable. Financial conditions have now tightened significantly, which should take pressure off the Fed to hike in Q4. Max, I'm pleased to say, joins us right now. Max, let's start with the data. Is good data good news for this market?
It depends, right? It depends on how good it really is. I think it's, when we look at it this morning, right, I think there's been this obsession in the last couple of months and really the last couple of quarters of talking particularly the US economy into a recession, right? So, you know, if we get sort of blowout data like we've had this morning, that certainly doesn't help the rate side, and then, you know, interest rate volatility goes up, and as interest rate volatility goes up, that of course does hurt the equity market, and it does hurt pretty much sort of all asset classes except for the US dollar, right, as you're showing right now. So that's really, it depends to the extent of these surprises. I would, however, say, look, when was the last time, for example, where you guys were reporting about really a streak, let's say a couple of weeks of significantly worse than expected data? It's probably been a couple of months already, right? There's this absurdly high obsession with talking the market down, equities down, and with talking the economy down. And in reality, look, things are fine. And particularly in the US, you know, the economy is just really chugging along.
Max, can we talk about the bond market equity relationship? And I'm not sure what comes first, the chicken or the egg, but maybe you can help me. Does this equity market need the bond market to stabilize, or does the bond market need equities to sell off to stabilize? What needs to come first?
Yeah, I think we need a little bit of bond market stabilization, right? So what we've seen in the last 4 or 5 years, I guess you guys have probably had a couple of guests on the show as well that have been arguing through the real rate angle, right? So real rates going up. That's really bad for equity multiples. But let's be honest, those charts, they always start sort of 2017, 2018. Before that, if you look between 2010 and 2017 and 2018, the relationship between multiples, equity multiples and real rates has actually been positive, which kind of makes sense, right? If we're saying, look, real rates up means growth is better. When growth is better, that means that people are willing to pay up, right? They're willing to pay a higher price if things are doing better. So that relationship has only really flipped from 2018 onwards, and it's broken up again about 1.5 years ago, where the relationship now is much stronger and has been really consistently for the last 3.5 years, is not between the level of rates and multiples, but it's really through interest rate volatility. So we need the pace of increase to really calm down a little bit, right? Interest rate volatility to stabilize a little bit, to perhaps subside a little bit. And as that happens, that then will actually stabilize also the multiple, because as you have a bit more certainty around where yields are eventually going to settle, that should then be pretty good also for the equity multiple. So
when you say stability, Max, this is important. We've had this conversation a few times. You're not talking about lower yields. You're talking about smaller moves.
Absolutely. So I'm not genuinely, honestly, I'm not really that bothered about 4.5 or 5%. What I'm bothered about is if someone tells me, look, I don't know where yields are going to be in a year. It could be 3%, could be 10%, somewhere in between, right? But the point is, if you look at the equity risk premium, right, and then think about it from a very top-down perspective, the point really is, if you have in the equity risk premium a bigger uncertainty around the second term, so really around your bond yield, the stuff that you subtract from the earnings yield, what you need is you need a higher earnings yield to basically compensate for that higher uncertainty around yields, right? It's not necessarily the yield itself, it's the uncertainty around where that's going to settle. And as that uncertainty goes down, that also then means that you need not as much of an earnings yield anymore, and that means it's good for PEs, right? It's good for the multiple then.
Max, I want to squeeze this in. Constructive all year, I've got that. Based on the year-to-date performance, right to be. Max, how would you express that constructive view right now? What's the optimal way to do that from your perspective?
Yeah, still underweight developed sovereigns, still overweight equities, maximum overweight high yield credit, right? Particularly in the US, we see very little sort of refinancing risk in 2024. Most of that only comes in 2025. Margins are still pretty stable. So to me, it's high yield credit, it's US equities, it's also energy still, it's LATAM equities, it's high yield credit in particular.
Max Kettner of HSBC. We've got to talk about that high yield call in weeks to come as we close out 2023. Max, thank you. Coming up on this program, another upside surprise on Wall Street.
These banks are actually making a lot of money right now. They're making a lot more net interest income than they did last year. Trading has been resilient.
Coming up next, Stephen Bigger of Argus Research on Goldman on Bank of America.
These banks are actually making a lot of money right now. They're making a lot more in net interest income than they did last year. Trading has been resilient. Investment banking is cyclically depressed but could bounce back. And so, a lot of these banks understand that you can't necessarily cut your way to glory. And so while we think they're going to be mindful of expense growth next year, I think that the question really is, how do they, think about revenue resilience next year?
Another round of solid bank earnings. Bank of America reporting its best Q3 results in at least a decade. Goldman topping revenue and investment banking estimates. The CEO, David Solomon, saying this: "We're confident that the work we're doing now provides us a much stronger platform for 2024. Bloomberg's Shonali Basak joins us now with more. Morning, Shonali.
Good morning, John. It is a show me the money story. If you think about what I mean by that, it's not just for investors. It is the capacity to lend. What helps Goldman Sachs during the quarter? This idea that trading revenue, both on the fixed income and equity side, was helped by their capacity to lend to the buy side. Call it Goldman's siren song to the buy side. They are open for business and they are looking to lend over some leverage. Over at Bank of America, net interest income was above expectations. They are lending to the consumer. You have Brian Moynihan saying that the consumer is still strong but slowing. And when they talk about the future of net interest income over at Bank of America, yes, they say the fourth quarter, it will trough, but they expect it to grow again in the middle of next year. So both on the consumer side, they are pointing to a brighter future, even with some concerns in the nearer term. And at Goldman Sachs, also for the institutions, you have David Solomon pitching the return of mergers and acquisitions, and they will be there to catch the ball when it lands. Now, Goldman Sachs is, according to Bloomberg's own league tables, back on top of that M&A league table. It was a stiff competition all year long, but they are trying to show you that Goldman is still Goldman.
Shonali, thank you. Goldman right now negative by 0.1%. Shonali Basak, always brilliant on the bank earnings every quarter. Let's continue the conversation with Stephen Bigger of Argus Research. A buy rating on Bank of America, a hold on shares of Goldman. Stephen, I want to go straight to B of A. Let's talk about Bank of America. What is it that's held this stock back all year? And do you see anything in the numbers, the communication from the bank this morning, that turns that story around?
Yeah, good morning. Strong results, I think, and mostly across the board, right? Net interest margin expansion versus the second quarter. We've been looking for lower margins because of the higher deposit costs. We had some loan growth. Deposits actually rose a little bit, flat to slightly higher, so that outflow has stopped. So I think a lot of good pieces to the story here. Still some concerns about the securities portfolio and the held to maturity. We did have quite a bit of an increase there, about 26 billion quarter over quarter. And that is some concern. It's going to take quite a while to wear off that number as interest rates have increased and put pressure on the securities portfolio.
So, Stephen, you've seen the communication from the bank this morning from the CFO expecting zero losses from that held-to-maturity portfolio, those securities. Stephen, I was talking about this earlier this morning. Never mind the losses. Does it hold back their earnings potential for quarters and years to come?
Well, relative to other banks, it will, and that probably is measured in many quarters to a few years. And I would reiterate that the holdings there vastly are agency-backed mortgage securities, U.S. Treasuries, so no credit risk here. This is just a function of them earning lower returns until that rolls off. So it does hinder earnings potential. Again, quarters to a couple of years until they roll off and they can get the benefit of higher rates.
Stephen, why do you think the valuation is compelling enough then to buy that bank versus another bank that doesn't have the same problems in quite the same way?
Well, I think they're spring-loaded, clearly for much better earnings as those lower-yielding securities portfolio roll off. So that's one thing. It's a very well-diversified franchise. I think they can catch up with the other diversified banks, which are doing much, much better. J.P. Morgan, Citi, for example, Morgan Stanley have done vastly better stock price-wise than have the regional banks. Right now, it is cast closer to a regional bank status than it is to the diversified banks. So they will benefit as capital markets revenues improve, whether that's investment banking, M&A activity. Trading results continue to be very strong. So I think they have a lot of untapped earnings potential here that will find its way onto the income statement over the next year.
Down this morning and down something like 20%, close to that level year to date. Stephen, thank you for being with us. Stephen Bigger there of Argus Research on the latest. B of A negative by just 0.07% in early trading. Let's quickly get you some sector price action. Here's Simone.
Hey, John. Yeah, it had been a pie of red to start the trading day, except for energy sector. Now we're seeing some other sectors come into the green, but IT, information technology, is still the one that's really dragging everything down. And if we look at the Philadelphia Semiconductor Index, we'll see what has been the impact of this news that the U.S. is restricting NVIDIA's new made-for-China chip sales. This was not entirely unanticipated, but NVIDIA most intraday since late December, and plenty of other semiconductor names getting hit as well, John.
Simone, thank you. Your trading diary is coming up next. Taking back almost all of yesterday's gains on the S&P 500, down by 0.8%. As the price action, here's the trading diary. Coming up, Congressman Jim Jordan expected to hold a floor vote for his speakership bid at noon Eastern. President Biden departed for Israel later this afternoon. Wednesday, more earnings, Morgan Stanley, Netflix, Tesla. Thursday, another round of jobless claims, plus Fed Chair Jay Powell headlining a week full of Fed officials ahead of the quiet period. From New York, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
like Bloomberg. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Tuesday, October 17th. Here are the top market stories that we're following for you at this hour. I'm on a budget, and apparently nobody else is. Retail sales re-accelerate in September. Stocks fall and bond yields pop. And you get a cash build. Bank of America's latest fund manager survey says cash levels are triggering a buy signal. We see if there's just too much cash on the sidelines. And Goldman flexes its trading muscles. FICC and equity trading smash estimates while return on equity slips. The stock, though, hitting a session low. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. I have to say, we were not expecting this when we did our editorial meeting at 7, that blowout retail sales number.
Really? We're supposed to believe that you really haven't been spending? What classifies as spending? What is discretionary spending in the Steele household right now?
I am so on budget. I'm now currently under budget.
Okay.
Look, when you come next week, I can show you my spreadsheet and we can go over it together.
Apparently she has written this down, which tells you everything you need to know about Alex Steele. But anyway, that's neither here nor there. Apparently Alex has been spending, but everybody else has not been spending, but everybody else has. Those who have been watching the show for a long time may question this.
It's true.
Obviously, I couldn't be in that possible position.
And you would be fair to question. Now, I do want to point out that we have been eating out a little bit more, and you can see that the only kind of services data that we got in retail sales number was eating out, which was up 0.9%. So maybe there's that.
Maybe that doesn't get included in the spreadsheet. Let's talk about our question of the day, which we did set at 7 a.m. Eastern Time this morning. It came after we saw the Bank of America Fund Managers survey, which pointed to the fact that as a percentage of AUM, cash is now at 5.3%, which they think over at Bank of America is a buy signal. So our question of the day is a fairly straightforward one. Is there too much money right now in cash? Let's try and get an answer to that question. Here in London, Michael Masika. Over in New York, Denitsa Sikova. Let's turn to Michael Masika first, because he's standing next to me. Answer the question. What do you think? Bank of America says it's a buy signal. Everybody's bearish right now. Everybody wants to be in cash. It's an answer that we get time after time after time. You want to be in cash. But have we reached the point of extremes?
So, yes, Guy, I mean, as we can see, this signal has been working quite well over the past 10, 15 years. Now, is it going to work this time? Maybe, could be. The seasonality is in favor of that. We have a lot of bearishness generally on the market. Funds are underweight, whether it's like a global, like a diversified fund. So asset allocator are underweight equities. They're massively overweight cash. Like if you look at the survey, what's striking is how much like funds are overweight cash. On the other hand, you have fast money, which is also underweight equities, even outright short equities for CTAs, for example. So it's all a combination of like max bearishness that tells you that the downside is probably very small at the minute, and that a slight bit of good news would help to push the market up.
He's trying. I feel like Michael's really trying there. Denitsa, what do you think? Is there too much cash on the sidelines? Because you could also make the point that like it's there for a reason, and we have a lot more risk geopolitically, for example, than we did a couple weeks ago.
Yeah, I think it's really hard to pick a side, but in terms of reasons, yes, there are many reasons. If you look at equity risk premium, at the moment, 10-year yields are offering kind of the same as S&P earnings. And if we look at cash yields, it's actually more attractive at the moment. So it's getting harder and harder to ignore that. This kind of has been the question all year, and we were so obsessed with there is no alternative, and this year all the other alternatives came up and all those different acronyms. Yeah. But it's been harder and harder to justify owning those more riskier assets like stocks, and you have to be really good at picking the right names to justify this, and obviously you have to pick those with strong earnings that are going to withhold from that.
Yeah, you talk about the comparisons that we can make, and we're talking in aggregate here. If there's very little room on the upside for equities, the comparison with cash is a real one right now. So if you don't believe that equities have got significant upside from here, isn't cash the logical place to be? How do we compare the risk, the relative risk of these assets right now?
I think that is the big dilemma that has been holding investors for a very long time. And obviously, like if you hide in cash, you're getting those great yields. But what if you miss the next rebound? And this is something that happened earlier this year. We saw a lot of people chasing gains because they were too defensive. They're on the sidelines, and then you miss a 40% rally in the Nasdaq. So it's really hard to justify that.
Yeah.
So it's a really hard trade-off. It's a really hard trade-off at the moment. But as Michael said, we saw a huge decrease in exposure. We're currently neutral. Some investors are underweight. So if there is a catalyst, there may be some big buying, which is what we saw this year has supported the big rally.
Alex, what I find amazing about equities, though, is that people tell me that the upside is limited, but the downside is limited as well. So equities feel really stuck right now in the middle, and that makes cash even more attractive. But maybe actually the fact that the downside is limited means that actually, to Denitsa's point, on the upside, maybe that's where the opportunity really lies, and that's where the risk lies, to the upside in equities.
I mean, maybe if your small caps have gotten like so wrecked on a relative basis. Well, Michael, but I think it begs the question, like, what is the trigger that puts cash back to work, particularly as we're going to head into the let's square your books so everything looks good into the end of the year scenario?
Yes, there is a bit of that. But what moves the markets, especially on a daily basis and on a weekly basis, is more like the fast money. And I think that's what's pushing equities higher or lower very quickly. And so the movement you can have can also then drag other participants into into buying more equities. And if you look on the long term, I mean, the logic is very simple. I mean, on a long-term basis, investors need to be long equities, and that's what's going on in asset allocation.
We just had potentially got 3 really terrible years for bonds, though. Why are we assuming that this cash belongs to equities?
Oh, that's a very good question, Guy, actually. And I kind of agree with you. There's probably a lot of this cash that will go into bonds at some point. But it all depends on what's your asset allocation and what's going to move the market, and that's I cannot really answer that one, but that cash will definitely split into both asset class when it's being put to work. You look at money market funds at the minute, they are like, you know, going through the roof in terms of assets. We're still like above like 5 trillion or something like that, and that at some point will have to decrease and be reinvested.
Denitsa, what do you think? Does it belong to cash and bonds equally? Does it belong to U.S. versus Europe? What do you think?
Well, I think it can go many places at the moment. It's important that there have been 1 trillion going into cash in the last 10 months. So you can argue a lot of money has come in and some of it can go other places. Of course, a lot of the big bond boots haven't been giving up. 3 years of losses, but still we even saw yesterday BlackRock upgrading their outlook on government bonds. So there are still many people that find them attractive at those yields that maybe see, you know, peaking rates. But of course, investors are also interested in investment grade. It's not necessarily all going to go there, but for sure, those some of that cash makes sense to be deployed eventually. Some of that cash came in so quickly that it makes sense.
Yeah, which kind of begs the question of what do alternative assets and then private equity and private credit wind up playing to that? How much of that cash on the sidelines belongs to that area that we don't, at least for private credit, we don't know how that performs in this interest rate environment and if there's a big downturn.
I'm wondering how much of this cash belongs to Saks Fifth Avenue and all the other big department stores as well. Is there a comparison to be made with the fact that retail sales on a day like today does really well, and everybody's cashed up at the moment? Maybe there's some spending going.
Saks would love to take your money. I'm sure they'd be more than happy.
Absolutely. But it does raise the question as well, if we do see some big movements in the market, whether or not actually that does have an impact on spending. Because at the moment, equity markets, you could argue, are holding up. Bonds maybe less so, but you're getting a rate of return if you're in money market funds. And I wonder what's going to tip that upper echelon of society, which still is spending quite a lot, into maybe spending a little bit less. Could it be something in the markets?
Yeah.
And at the moment, they're kind of parking their money, waiting, watching. But if something changes significantly here, you just wonder what the macroeconomic effects could be.
Yeah, and we're all waiting for the cracks, right? And then I mentioned it earlier, we were talking about this earlier also, Guy, is the cracks in small caps. Like, that's where the problem is.
Yep.
And we had Harker talking about that yesterday, that, look, the small businesses are really feeling the pain. Like, this is really where the crack is. All right, guys, thanks a lot. We appreciate the conversation. Denisa Zakova and Michael Masika, thank you very much. So coming up, more insight into the question, I should say. Is there too much money in cash? What do you do with it? Gargi Chowdhury, BlackRock head of iShares Investment Strategy Americas, joins us next. This is Bloomberg.
Thursday, the Economic Club of New York hosts a conversation between Fed Chair Jay Powell and Bloomberg Wall Street Week's David Weston. Recession risk, inflation outlook, real estate amid high rates, and more. The live interview happens October 19th at 12 p.m. Eastern on Bloomberg. Context changes everything.
There's a lot of concern about the consumer.
There's more headwinds now for the consumer.
Still headwinds to the consumer. How the consumer is faring the inflation pressures.
And a bifurcation of the high-end consumer versus the low-end consumer.
High interest rates are playing both on the consumer spend, consumer balance sheet.
Wages, we need to see the economy and inflation start to cool.
There's still ongoing battle with inflation.
Recessionary fears do really come back.
We're already worried about a recession.
We're expecting the U.S. economy to go into a recession.
We're probably going to see slowdown.
We've seen a slowdown coming, and it hasn't manifested.
Whenever that deceleration in the economy does arrive.
It's just too soon to say whether we're truly out of the woods.
There's some Bloomberg TV guests speaking earlier on the state of the U.S. consumer, which people are really worried about, but then you get the number today and it's like, concern? What concern? So all of this brings us to the question of the day. We got that Bank of America Fund Manager Survey report that says we're 5.3% in cash and assets under management. So is there too much money in cash? Here with us now, Gargi Chowdhury, BlackRock head of iShares Investment Strategy Americas. Is there too much money in cash, Gargi?
Hi, Alex. Great to be on with you. So, great question. Obviously very topical given the data today. As I was thinking through this question, I took a look at, how much cash is there as a percentage of the total U.S. bond and equity market. And if you look at that percentage, it's about right now, as of today's 5.7 trillion. We're sitting about 8%. 8% of the total investable market is sitting in cash. We have certainly seen numbers higher than that in the past. But important to note that when that that has happened, we have been in some sort of global crisis. So during COVID and during the GFC. So is there too much cash? I think given expectations of perhaps a slowdown in the quarters to come, and given the yields that you're getting in the very front end of the curve, I would say that it feels fair. Cash is an asset class right now. Investors are going into, if I look at ETFs, into things like SGOV and SHY. Cash is an asset class. And if you think that the economy is going to slow down and we're going to see some underperformance on equities going forward, I think that makes a little bit of sense. But I think bond markets are where investors should be looking to deploy.
Gargi, how sticky do you think that cash is? Everybody's put the money into the money market accounts. They're trying to figure out what they're going to do with it. How easy is it going to be to extract that money from those accounts?
I think it's going to depend on what and when we see the yield curve begin to renormalize. And of course, we saw a little bit of that steepening move already taken place. But till we expect, or till we have higher yields sitting in money markets, then you get, stepping out into sort of the 5-year or the 10 or the 30-year part of the curve, I think the money is going to remain stickier, especially, and I think this part is important, especially as growth expectations begin to decline for Q1 or even for Q4. I think the second part is important. Again, we're not going to call it a recession. I think it's just a question of whether or not growth is going to slow down from the tremendous pace that we've been at. So I think till we begin to see some normalization in the yield curve, I think it's going to be very difficult to get investors, especially in the bond market, where I think is where the opportunity is, to meaningfully step out into duration into, that 10, 20, 30 year. But where I think investors are and have already been moving to is really in that front end, in the belly of the curve as well. I think it makes a lot of sense now, especially with the amount of risks that are out on the horizon, to step out just a little bit, move out of cash, but don't take too much duration risk quite yet.
So, Gargi, the money then eventually belonged to the long end of the bond market, not to Sachs and not to the front end. But so the timing then, we have to see a slowdown, and I guess what indicators are you looking for that slowdown?
Yeah, I mean, listen, I think that right now, any indicator that any of us are looking at have been very, very robust. Just over the last 3 weeks, if you think about what we got in terms of the job market, what we got this morning in retail sales and industrial production, what we're looking at just generally in terms of CapEx, and of course, we're all watching earnings season to see how companies are talking about their own spending plans. All of that still very positive. I think we need to look ahead to what I am looking at is certainly any signs of moderation or slowing in the labor market, any signs of slowing in wages data. We haven't seen that yet. That is not to say that's not going to come. I'm certainly also taking the oil price and the recent moves that we've seen in oil, that into consideration, as well as that is going to eventually be another dampener on consumption and consumer spending, as well as, of course, October, as we know, is the period when student loans come back online. So there are all of these risks that are in the horizon that I think we have to keep in mind, but the data so far extremely robust.
Gargi, our colleague David Weston is going to be speaking with the Fed chair later on this week. Do you think Powell's done? What do you think is happening here? You've just seen a series of very strong economic prints, payrolls, retail sales, UMISH. There's all kinds of things going on here that point to the idea that maybe the Fed may have more work to do.
So I think we've heard from a slew of Fed speakers over the last week, about 7 of them to my count, and the messaging has been around the financial condition tightening, doing a little bit of work for the Fed. This idea that the long end of the curve has bear steepened so significantly, and whether that's worth maybe perhaps one hike or a little bit less than that, that is a narrative that we've been hearing from both the hawks and the doves. And we heard that even post post that very strong 0.323 core CPI print that we got last week. So I think that it's too early to say that they're done for sure. I definitely think that the trajectory of the data over the last 2 weeks has made me question whether they might go in December. I think they're done for November. I think we can all agree that the Fed has and other Fed speakers have definitely signaled to them being done for the November meeting, a little bit of a pause, a repause if you will. But I think this definitely keeps December in the cards, especially if there's a re-acceleration on the CPI front. Especially the one thing that scared me just a little bit on the CPI data was, of course, that shelter. Now, this can be noise. It's 1 month. But if it's not, if we see one more print of shelter re-accelerating, I think that does bring one more hike into consideration. But I also think that the market is priced for that. We're at 50% right now as I left my desk and I looked at the WIRP screen, which feels fair. 50% for December feels fair. So the market is priced for that. And I think that the Fed, for what we will hear for Thursday, is whether there's a continuation of the narrative of the market is doing our work for us, if Powell also uses that narrative, or if he actually points to the string of strong data that we talked about just now, especially on the labor market as well as the inflation front. I will say one of the things that we've been focusing on in our in our fourth quarter guide that we just came out with was really focusing on, within this macro uncertain environment, focusing on quality companies, focusing on energy and industrials on the equity side, and then focusing on the belly of the curve and inflation-linked bonds on the debt side.
Gagi, great to catch up. Thank you very much indeed for joining us. Love the work function. Always good to highlight that. Gagi Chowdhury of BlackRock. Still ahead, let's turn to tech, see what's happening there. NVIDIA, the latest company to be hit by US restrictions on Chinese chips. Details to follow. The startup is next. Ed is waiting in the wings. This is Bloomberg.
All right, it's 7 on the West Coast. We want to get to the startup where we cover the top tech stories from the Bay Area and beyond. As Silicon Valley starts its morning, Bloomberg Technology co-host Ed Ludlow joins us now. NVIDIA, back in the news, Ed. The U.S. is restricting NVIDIA's made-for-China chips.
Yep.
I mean, this is getting really extreme.
Extreme also based on the share reaction, right? NVIDIA down significantly. I think this puts it on track for its biggest drop since May. What you should note about this story is that the US is expanding its technology export curbs to the A800 and H800 GPUs. These are slightly lower performance GPUs that NVIDIA created specifically for the Chinese market in response to the original curbs that were put in place last October. And the reason that I flagged the severity of the decline in this session, you see it there now, 4.5%, is that Bloomberg reported back in June that this was going to happen. And it has happened, but the market still seems to be concerned.
Okay, let's extrapolate. How much further does this go? How big an addressable market does NVIDIA now have in China?
So historically, and this is true of the last quarter gone as well, data center sales in China makes up about 20 to 25%. You know, if you go on X, the platform formerly known as Twitter, or any of our social channels, I just did a piece that explains how actually GPUs end up in the real world. They aren't sort of a little chip you can hold in your hand. They ship to data center operators. And so it's a critically important market. And NVIDIA has issued us a statement this morning that is short, but my goodness, there's a lot of emphasis on the last line. Near term, there's no impact to financial results. Long term, they've told us how worried they are. But this is the situation for NVIDIA. Anyone right now will take one of their GPUs if they can get their hands on it. So if they can't ship the A800 and H800 to China, you'd bet that there is a buyer out there. Everyone wants a GPU that can be used in the use case of training foundation models.
Yeah, so it's like, okay, you don't give it there, there are other customers elsewhere, I get that. What else could be a risk, though, for NVIDIA? What's the next thing that they're worried about?
Well, the way that NVIDIA's positioned it is that China is the most strategically and volume important market in the world, be it in consumer electronics. And we'd note that in these latest US curbs, semiconductors which go into consumer products like smartphones are exempt. But in the data center context, it's still critically important. And what NVIDIA's argument has been is that by doing this long term, the US is saying to its biggest technology companies, you cannot play in the world's most important market, which obviously is a worry.
Exactly, and that's the point. It's interesting, we're going to get ASML, they're talking about this as well.
Yeah,
this is a story that is writ large across this entire sector. They're very upset. Ed Ludlow, thank you very much indeed. Ed and Caroline, Bloomberg Technology, coming up in around 90 minutes time. Markets coming back a little bit, stocks are coming back a little bit. We're going to talk about J&J next. Joseph Watt, the company's CFO, is going to join us. This is Bloomberg.
We're about an hour into U.S. trading session. I got to say, equities are off the lows of the session, but yields still pushing higher. Bloomberg's Natalia Knežević joins us with more. Natalia?
Right, so stocks are moving lower. The S&P 500 is down by 0.3%. NASDAQ is down by 0.7%, and yields are moving higher. The biggest story today is retail sales. Numbers were hotter than expected, and for many investors, it just reconfirms the case that the Federal Reserve will keep rates higher for longer. A few corporate stories we are watching today. First, banks. Goldman Sachs and Bank of America reported earnings today. Goldman is down by 1.8%. So the biggest story here that yes, net revenue came slightly above expectations, but that was the 8th quarter of profit decline in a row for Goldman. One of the key takeaways for investors is that bank reported a 33% drop in profit, and that was largely due to its exposure to the real estate market. However, Goldman's revenue from fixed income, currency and commodities, or FIC, and equities trading exceeded estimates. But analysts are saying it was a messy but in-line report. The next one is Bank of America. Shares are up by 0.6%. The main story here is that fixed income and equity traders reported the first third quarter report in a decade. And the key takeaway here is that stock equity revenue from trading was up by 10%. On the macro level, CEO spoke on the earnings call, and he said he sees a decline in consumer spending. And one more stock we are watching today is Johnson & Johnson. The stock is actually down. However, the company provided better than expected forecasts for the next year. But the biggest question for many investors is, will J&J be able to provide stronger earnings from its new pharmaceutical and new drugs? But overall, the report was good. Adjusted EPS and revenue was higher than expected.
Great stuff. Thank you very much indeed. Perfect. Sets us up for our next conversation. J&J's results front and center. The CFO, Joseph Wolk, joins us now. Joseph, great to catch up as ever. We always appreciate your time on a busy day. Look, you've raised sales guidance, top-line guidance, operational guidance. The market's a little softer, but to be honest, the market's all over the place right now. You've done the Kenvue spin. That's kind of in the rear-view mirror. What's the message I should take away from these set of numbers if I'm an investor in J&J?
Yeah, thanks, Guy. Good morning. It's a pleasure to be here with you and Alex, and appreciate your interest in Johnson & Johnson. I would say, you know, if this is a third quarter that was very strong, it dovetails into what has shaped up to be a very strong year. And I think we're going to take that momentum into 2024 and beyond. Certainly, we're getting very good performance out of products that have been on the market for a while in both innovative medicine. So you can think about some of our immunology products like Stelara, Tremfya, Darzalex, but we've got new products in that portfolio. This week alone, we're going to have the beginning of several data readouts in areas like small cell lung cancer, in bladder cancer, in rheumatoid arthritis. So we're very optimistic about the future, not just for the balance of this year, but beyond. In medtech, electrophysiology continues to print 20% growth quarters. We have new products coming in that portfolio. We're going to continue to capture share. And then lastly, with Abiomed, the world's smallest heart pump, Impella, we continue to enroll clinical trials as planned when we made that acquisition about a year ago.
Hey, Joe, good to see you. For the medtech growth, what kind of growth can we expect sort of in the fourth quarter?
Yeah, so we're looking at year-to-date, we're just a tad under 8%. We are seeing elevated procedure levels based on where we were in 2022. So the medtech market overall is typically, we'll say, 4 to 6%. We see that more in the area of 5 to 7% this year, and we see that carrying into 2024.
I think some people might have been anticipating that the top-line guidance raise was going to be a little bit more, and that does raise the question about maybe what's happening on the cost front. What is happening on the cost front? What kind of inflation are you seeing right now? What can you do? What are you going to be doing more down the road to control those costs?
Yeah, so Guy, I think in terms of the top line guidance raise, which was a net raise, it was offset a little bit by a stronger dollar. When we published Q2 guidance, the euro to the US dollar ratio was 1.10. Today it stands at 1.05, 1.06. So a little bit of a hit there, taking away from the operational performance. In terms of margins, though, we really proud of what the team's been able to accomplish this year. As you noted in your tee-up, we did separate the consumer business, known as Kenvue today. Typically, a business that separates a business of that size has dyssynergies. The team has really rallied around, and we are looking at next year having zero to little dyssynergy cost effect from the separation of the business. So very proud of the work that's been done. And we took it a step further in terms of looking at our infrastructure for a two-segment company. So we've used AI, machine learning, to improve some of our enabling functions like finance, HR, and we're also using that in some of our R&D processes as well.
Hey, Joe, if AI was sort of the buzzword on the call, say like last quarter, the buzzword for every company now seems to be obesity drugs.
Yeah.
You guys aren't in obesity drugs. Do you need to be? I mean, Goldman Sachs says it could be a $100 billion market in 2030. Do you need to get in there in some meaningful way?
Yeah, you know, when we look at the GLP marketplace, and you're right, Alex, we don't have anything there today. I think it's really a testament to the life sciences industry and what the solutions that we're able to come up with. A lot of rhetoric has been out there about what's it's going to mean to our med tech business in a negative way. We kind of see that through two lenses. Certainly, there's people who were perhaps candidates for bariatric surgery who are suffering from obesity, who maybe now are going to defer their decision, or maybe even not be candidates for bariatric procedures down the road. However, today there's people who can't receive hips or knee replacements, who can't take cardiovascular procedures because of the obesity effect. So we actually see this as potentially opening up a whole new channel of patients for potential procedures down the road. I think we're going to have to let time play out, but all in all, we know that reducing obesity is good for overall health.
What do you make of the buzz, Joseph? Honestly, you work in the industry, you see what's going on. There seems to be an awful lot being written, talked about this subject right now.
Yeah.
Do you think it's being overhyped? What is your sense as an insider into the industry as to what is going on here?
Yeah, I think it's early, guys. Whether to say it's overhyped or not, I think it's great science. It has the potential to really help a lot of people. Again, people will have the opportunity to live longer, but they're still going to need those procedures and perhaps other therapies. So, you know, I think there's a balanced approach and more of a wait-and-see approach at this point. But it is, again, as I stated at the outset, just a great testament to what life sciences can bring to society.
Not to harp on it, but one more question on it. Sure. You had Goldman Sachs saying that currently it's a duopoly market, Novo Nordisk and Eli Lilly, right?
Yes.
And I appreciate what you're saying in terms of this is how we can sort of support, there'll still be the need for surgeries, et cetera. If you had to sort of look at expanding J&J's footprint into this in some capacity, what would you need to do to build that part of your business up in some way?
Yeah, so Alex, where we've been really successful is kind of sticking to areas where we've got deep scientific expertise. You look what we've done in oncology, specifically prostate cancer and multiple myeloma. It's unprecedented how we've brought solutions for people who are suffering from those types of cancers. Where we've been successful, whether it be med tech or innovative medicine, is those areas where we have scientific expertise or a very near-term adjacency. So we have gone into new areas, as we did with the Impella heart pump and Abiomed, as we did a few years back with pulmonary hypertension. So we'd have to look at the right opportunity, doing it in a disciplined way, making sure that it bears the right return, and the asset can create more value in our hands than where it currently resides.
Okay, fair enough. Hey, Joe, we really appreciate checking up with you. Thank you, Joseph Wolk, Johnson & Johnson CFO. Thank you very much. All right, coming up, JP Morgan Asset Management is out with its annual long-term outlook for markets. We're going to talk to the authors of the report, David Kelly, Monica Issar. Coming up next, 60/40 is still back. You just got to have some alternative assets in there. This is Bloomberg. and bonds continue to move together. Equities lower, bond yields higher. So what do you do with a 60-40 portfolio? Well, JP Morgan Asset Management is out with its long-term capital market assumptions report. It highlights a period of significant economic transition. Still believes in the 60-40 portfolio, maybe a little bit more, though, tilted to alternative assets. Here to discuss are David Kelly, Chief Global Market Strategist at JP Morgan Asset Management, and Monica Issar, Global Head of JP Morgan Wealth Management Multi-Asset Solutions Group. Guys, thanks for being here. Good to see you.
Great to see you.
All right, give us the big picture, because, David, you were with us last year when you guys came out with the report. So 60-40, but more geared now towards alternative. Walk us through what you're seeing.
Well, yes. So a year ago, we were saying that over the next 10 to 15 years, you'll make 7.2% out of a 60-40 portfolio. That's come down to 7%, but that's not actually a big drop given how much the equity market's gone up. But we do think that with repricing in the alts market, it makes sense to have alts in a portfolio. It's not really just about 60-40. It's about having alternative investments in there also to diversify a portfolio. We think that's going to be more important going forward, partly because of a lot of these transitions that we're seeing in the global economy.
Monica, great to see you. Thanks for joining us. Look, there's a great deal of uncertainty at the moment in the world. What's your degree of certainty as to the track that investors should be on right now? It does seem as if markets are being pulled and pushed on a daily basis.